Welcome to FIRE's educational video series. In this video tutorial, we will continue with our discussion on technical analysis. In the previous video, we talked about what a time frame is and the different time frames that are available for viewing on various charting platforms. In this video, we will continue with our discussion on time frame. By the end of this video, you will know the importance of analyzing securities using multiple time frames. So, without any further ado, let us start with our discussion on multiple time frame analysis. Each trader or an investor has a different set of objectives. Some trade for the long term, whose time horizon varies from a few months to several years. Such a type of trader may not find much utility in the daily chart. Instead, what he or she would rather look at is something like a monthly chart or even a quarterly chart. Then, there are some who trade for the medium term, such as for a few weeks to a few months. Such type of traders may not find much utility in hourly charts. Instead, they would rather look at the daily chart or a weekly chart. Finally, there are some who trade for the short term, such as for the intraday or just for a few days. Such type of traders may not find much utility in the monthly charts. Instead, they would rather look at an hourly chart or a 15-minute chart. What this essentially means is that every trader or investor will look at the time frame that suits their style and tenure of trading or investing. Multiple time frame analysis involves using more than one time frame when analyzing the price of a security. For instance, if you are analyzing the price trend of a particular stock, multiple time frame analysis would involve analyzing the chart not just using your preferred time frame, such as say the 1-day time frame, but also using say the 1 week and or the 1 hour time frame and so on. Irrespective of whether you are trading or investing for the long term, the medium term or the short term, it is important to use multiple time frames when analyzing the chart of a security. Doing so would give you more confidence when entering into trades. One major advantage of using multiple time frames is that they help in confirming trading signals. Let us understand why this is the case using a real-world example. This is the daily chart of Maruti. As you can see, since bottoming out in April, the stock has been steadily heading higher and trading above the black rising line. Notice the shaded region, which shows the period when price touched the black line and resumed its up move. This indicated at a continuation of rally. Let us now drill down to the hourly chart of Maruti and have a look at the exact same period that was highlighted on the daily chart. Notice that the hourly chart gives a more microscopic view of the daily chart. See that after touching the black rising line on multiple occasions, the price then went on to rise above the falling blue line, giving a confirmation about the resumption of the up. Notice how the larger time frame chart, that is, the daily chart in this case, helped to identify the larger trend, while the shorter time frame chart, that is, the hourly chart in this case, helped to identify the entry level to trade in the direction of that larger trend. That is the benefit of using multiple time frames. The larger time frame helps in understanding the direction of the larger trend, while the shorter time frame helps to trade in the direction of that larger trend by identifying better entry and exit levels. The other advantage of using multiple time frames is that they help in filtering out the number of trading signals. One common adage in technical analysis is that the trend is your friend. What this means is you make money by trading in the direction of the larger trend rather than against it. To understand this, let us again use a real-world example. This is the hourly chart of Reliance Industries. The dynamic blue line is the 100 hourly moving average of price. See that initially the price was trading below this average line, indicating at weakness. However, later the price moved above this average and started trading above it, indicating at strength. Notice the region marked using the green arrow and the corresponding shaded region. This shows the period when the price retested the average line and started to rise off it. You may feel this was a good region to buy, wasn't it? Unfortunately, the answer is no. As you can see, after a brief rally, price started declining precipitously and moved below the moving average line. Why did this happen? Could a larger time frame give us an answer to this? Let us look at one. Let us now look at the daily chart of Reliance Industries. In this case, the dynamic blue line reflects the 100-day moving average of price. Notice the shaded region in the chart. This shows the exact same price data that we saw earlier on the hourly chart. However, unlike the strength that was depicted by the hourly chart, see that the daily chart was depicting as weakness as the price was trading below the moving average line. In fact, see that the price exactly touched the average line and started declining from there on. Being aware of what the larger time frame chart was suggesting would have alerted the trader to ignore the counter trending signal that was generated on the lower time frame chart. Now that we understand the importance of using multiple time frames, the next question that you might wonder is, how many time frames to use? Well, the number of time frames that one decides to use varies from person to person. Some prefer using 2 time frames, one larger and the other smaller, while some prefer using more than 2 time frames. As a rule of thumb, we recommend using 2 additional time frames besides the preferred time frame of your choice. This would include one smaller time frame below your preferred time frame and one larger time frame above your preferred time frame. For example, if your preferred time frame is daily, then the other 2 time frames that you should possibly look at are, say, the hourly and the weekly. Doing so would have 2 benefits. The first benefit is that by looking at the larger time frame above your preferred time frame, you would be able to identify what is the larger trend of the security. Meanwhile, the second benefit is that by looking at the smaller time frame below your preferred time frame, you would be able to time your trade better and find attractive entry and exit levels. Again, remember that the idea is to trade in the direction of the larger trend. The table below displays a few combinations of how to use 3 time frames when analyzing a security. Consider pausing the video here to go through the various time frame combinations. Notice the sequence of the multiplier in the table. You will see that the middle time frame is anywhere between 3 to 5 times the smaller time frame, whereas the larger time frame is also anywhere between 3 to 5 times the middle time frame. Besides the combinations mentioned above, you could also choose other combinations depending on your style and preference. But when doing so, do ensure that the sequence multiplier is not too small, else there will not be noticeable difference between the charts. Well, that was all that we wanted to cover in this video. If you liked our video, do not forget to click on the like button below. Also, hit the subscribe button to subscribe to our YouTube channel and the bell icon to receive regular updates about new videos. Thank you for watching this video.